In this video, I'm going to take you through a step-by-step approach on how I personally built 3 profitable ICT models. Now, a lot of people overcomplicate this, guys. And believe it or not, even though I'm from Australia, if you can't tell from the accent, I've traded every single session. So I've traded the Asian session, London session, PM session, the AM session, and I've seen success in all sessions. These things I'm talking about today, even though I trade futures personally, they are going to apply to all contexts, to all instruments. It's going to work on gold, it's going to work on Forex, doesn't matter what pair it is. And really my goal and my aim now, once I've learned these processes myself, I want to portray this to you guys. If you're ready to take the steps to become a profitable trader in 2025, watch the whole way through. I've got chapters in this video and actually apply everything I'm saying in this video. With that being said, let's get straight into this video. Let's go. Firstly, let's start from the bare basics. And what I've highlighted here on this flowchart are 3 different asset classes. So we have futures, Forex, and commodities. So futures could be the NASDAQ and ES. Forex could be pairs like GBP USD, Euro USD. Commodities could be things like platinum, gold, and also silver. Now for me personally, I've traded these 2, but the focus of today's video is going to be on futures. To give you guys a little bit of insight as well, I actually started with Forex and I traded that during the London session, and then futures I started trading in the New York session. Now when I was trading Forex during the London session, I kind of got sick of the spreads, I got sick of the commissions, and when you trade the futures market, there will be 0 or very minimal spreads, right? So you can enter price, for example, at a level like this, and it can come this close to your stop loss and you're still going to be in that trade. With Forex, that's not the case, and especially for me as a scalper and building scalping models, it didn't really work for me. So I traded futures, I found it much easier. A lot of these newer prop firms I'll talk about, Top Step, Apex, MyFund Futures, these are also futures-based prop firms. Now that we've actually decided what instrument we're going to be trading, you need to understand the mechanics of how it works, guys. This is crucial. Firstly, you need to understand the difference between mini contracts and micro contracts, because mini contracts are actually worth more than micros. And I'll actually put a table on the screen here just to illustrate that fact. Now, on top of this, you need to understand what a handle is, because a lot of people talk about handles, and even myself, I talk about take 10 handles, take 20 handles. All I mean is exactly what you're seeing on the screen here. So I've marked out the supposed, entry, the take profit, and also the stop loss level. And I've marked out on the right-hand side here how you calculate that. Essentially, you can get any price point. It could be 21,000, for example. And if the price moves from 21,000 to 21,001, that is one handle. One question I get asked all the time is, Ruben, do you prefer props or personal? Now, as a personal experience, speaking personally, I have way more experience with prop firms, and these here are the main 3 prop firms. So we have MyFund Futures, we have Apex, and we also have Top Step. These are not the only 3, but these are the main 3. And each of these prop firms I've personally had payouts with, and multiple payouts with. I'll put those on the screen here. These are payouts from last year, consistently every single month. I started with Apex, then I moved on to Top Step, and now I'm working mainly with MyFund Futures. If you want a video that compares each of these prop firms, like 1, 2, and 3, just let me know, because I'm happy to actually make one in the future. But ultimately, these prop firms save you money in the long run if you do it the right way, because the prop firm allows you to get into the markets, number 1, at a very low cost, but also to practice your skills in the market too. If you're using a personal account, you can blow a full $1,000 in one day. So I think for anyone, a newbie, a beginner, someone that's intermediate, or someone that's advanced, there are definitely benefits to taking props over personal. And while they're here, why not utilize the actual space in the prop firm industry? For some people watching this, you may be concerned like I was when I first started trading, because you may be from Australia or New Zealand or any other country from across the globe where maybe this session is not really accessible. And I have a lot of people ask me the same question, like, Ruben, I'm still working full time, I'm struggling to get enough sleep because everyone that I see on social media is trading this session. Is that the only session you can trade to be profitable? No. And that's what I thought when I first started. Unfortunately, a lot of the big influencers, a lot of the big names, they trade this session. For me personally, I don't trade that anymore. I trade the London session, the Asian session, and sometimes the New York PM session. I was struggling to trade New York session because it was so late. And then I asked myself this question: Could I trade London and Asian session and still be profitable? And the answer I have for that is yes. Now, what I've marked out here is some times that you can look to trade these sessions. Of course, you've got to decide what instrument you're choosing. You've got to look at prop firms versus personal. You've got to look into risk management, minis versus micros, all that kind of stuff. But ultimately, you need to understand that different sessions have different volatilities. But these are the times that personally I like to trade, or that ICT has mentioned that you should trade these sessions. So Asian session starts at 7 o'clock and it goes until 12 o'clock. I want to reinforce this point. Every single thing I talk about is in New York time. So these are New York times. I'm from Australia. Set your chart on TradingView to New York times. Just makes it a lot easier when we're discussing these concepts. London open session is 2 to 5. The New York PM session, I've found success trading anywhere really from 12 to 4:10. And the New York AM session really anywhere from 9:30 to 11:30. Realistically here, yes, these are some of the key sessions. You've got times in between that. I've traded all day, guys. I've traded as early as 6:30 p.m. I've also traded as late as about 4:05 to 4:10 p.m. I've traded all these days, all these sessions, and what I've actually found is that anything can work, any session can work. It's more about finding something that's repeatable. So yes, I know ICT says don't trade the lunch hour. For example, the lunch hour could be from 12 o'clock to 1 o'clock, New York time. So 12 p.m. to 1 p.m. Have there been good setups in that time? Yes. I know ICT promotes silver bullet sessions and they are going to be between 3 to 4 a.m. New York time for London session, and also 10 to 11 for AM session and 2 to 3 p.m. for PM session. However, are these the only times that you can trade in the AM session, the London session, or the PM session? No. And I just really want to reinforce that, because a lot of people might work, they've got commitments, they've got kids, they've got sports, and you might be sitting there saying, I can't trade the silver bullet. I can't trade the London open session. Is it okay if I trade at 6 a.m? Yes. Is it okay if you trade at 7 a.m? Yes. Any time is tradable. You just got to look and collect data, like we'll talk about in a second, to make sure that you're seeing the same things repeat. From the least to the most volatility, we've got the Asian session as the least and the New York AM session as the most. Now, this is really important. I've traded all sessions and all sessions have their own volatility. Just to illustrate this point further, here is an example of a trade that I've taken during the Asian session between a macro of 650 and 710. Here is an example of a trade I've taken between the 1250 to 110 macro. And here is an example of a trade that I've taken during the London Open session. Just to illustrate, guys, that anything can work throughout the whole entire day. Please do not limit yourself and think that you can only trade within a 1 hour time span. If that's all you can do, that's all you can do. But if you can trade whenever you can across the day, you've got a lot of opportunity, and then it comes down to which setups are you going to take and which things do you see repeating the most. If you can only trade for an hour a day, then trade for that hour a day and look for setups in that time frame. It's not about trading when everyone else can, it's about trading when you can and making it fit your lifestyle. It's not worth losing sleep over. I've gone that route. I've actually traded in New York session at 2, 3 in the morning and stayed up to about 4 or 5 in the morning just to look for trade setups. But it's not sustainable. You're not going to think clearly, and in the long run, it's not going to be good for your mind or for your body. So just know you can trade any time throughout the day. There's going to be setups. You just need to look for those setups and collect data so you know what you're looking for. And we'll talk about that later on in this video. Alright guys, now that you've actually decided what you're trading it on, and when you're trading it, let's discuss the topic of risk management. Really, really important. Now what I've outlined here, these things, 1, 2, 3, 4, 5, and 6, these are the 6 elements that I've broken risk management into, and you should answer these questions for yourself. And we'll go through a few examples today just so you can see what I mean. Number 1, you need to have a loss goal. So how much are you willing to lose per day? Number 2, how many trades are you going to take? And this will feed directly into the loss goal. So for example, if you want to lose $400 per day and you're risking $200 per trade, you can then take 2 trades. That's it. And then you're done for the day. What risk to reward do you want to aim for? A 1-to-1, 1-to-2? I would personally play around with this. Start with a smaller risk to reward, and if you want to go for more, let that happen as time goes on. Then you need to have a process of losing and a process of winning. And you might be like, well, what is that process of losing? What is the process of winning? When you take losing trades, what do you do? That's all I'm saying. Do you leave the charts? Do you shut your laptop? Do you go outside? Do you do exercise? Do you do something to distract yourself? Do you watch TV? Do you watch YouTube? You need to have a process of what you do when you take a loss to make sure you keep yourself in check. The same applies with winning, because in trading, guys, it's either going to be fear, F, or it's going to be greed. If you win, I've been guilty of this, you come back, you're up for the day, and then you end up losing for the day. So you need to have a process of what you do when you lose, but also a process of what you do when you win, and you need to have a profit goal, in my opinion, when you start. If you're going to lose $200 a day, then why not have a profit goal? Why not aim for something, and then when you reach that, you're done. Call it quits, leave your stuff in your study, leave it away, close your charts, do something different, and come back to it later. It's really, really important. Now, what I can show you guys are two accounts and two different sets of stats. And one account here is with 10 trades, the other account has a larger sample size with 50 trades. So the more realistic account is the one with 50 trades, but I'll talk about the differences between the two. Now, looking at this one here, if we just have a look at the average win and average loss, you can see in this case that, yeah, the average win is much bigger than the average loss. Like the average win is $225 and the average loss is only $90. Now this gives us a profit factor of 2.48. It also gives us a risk to reward of around 2.5. So when we actually apply that to a chart to see if what I'm doing is profitable, we can use something like this, right? A risk to reward calculator. Now we said that our win rate here is only 50% and the risk to reward is roughly about a 1 to 2.5. What I'm going to do here is highlight a few things for you guys, and I want you to follow along and do this for yourself, because in order to have a profitable strategy, guys, you need to understand this table, but also put your statistics across this table and see if it's going to be profitable in the long run. So the win rate here for me is 50%, and the risk to reward is between 1 to 2 and 1 to 3. So ultimately it's here. If we go where these 2 points intersect, we can see that my account after 10 trades was sitting in quite a bit of profit, healthy profit. Anywhere in this green zone is completely normal and completely fine. Now, thinking out loud here, a lot of people are going to say, well, if I have a profitable model, does that mean I win all the time? And the answer I have to that is no. So essentially, you can have a low win rate, but you need a high risk reward. If you have a high win rate, you can have a low risk reward. And this is something that everyone will experiment with and I guess find what works best for them. But that's just one account. What about this account here? This account here has, 50 trades, way more trades, larger sample size here. We've got the average win and then the average loss. We've got a profit factor of, let's just say, 1.5, and then the risk to reward being 1.5 as well, right? So ultimately similar numbers. Now, for a lot of people, they might be saying, well, what is the profit factor? The profit factor is simply the total profit, the gross profit, divided by the losses, right? That's all it is. And you need a number greater than 1 to prove that you have a profitable model. So a number greater than 1 is good. And I'll put a little snippet up on the screen here now too, in terms of what's considered a good profit factor, a great profit factor, just so you can see that what I'm doing is profitable. And these things that you build, these models that you build, once you collect enough data, you'll determine this for yourself. Now, it's not always going to be a 2.4 or 2.5. As time goes on, obviously probability plays out. But after a larger sample of data, you can see here, it's still a profitable strategy. And even here, right, we've got a 50% win rate and we've got a 1 to 1.5 risk reward. Now, let me get another table on the screen here and let me just talk about what this looks like in terms of profitability. Now, going into this table here, you can see the risk to reward on the top and you can also see the win rate on the left-hand side, right? Different tables. This one here just has a bit more data there, so you can actually have a look to see where it fits in a bit better. Now, if we mark out our win rate, which is 50%, the risk to reward was actually 1 to 1.5. We can actually plot this on the chart. So we're looking at this section here, 50%, risk to reward at 1 to 1.5. And again, we go to where these points intersect and we are still in a level of profit. Now, of course, being higher in this green section means that you're more profitable, but is this still a profitable model and strategy? Yes. Right, so keep in mind that this profit factor, this win rate, the risk to reward for me, it'll fluctuate from the start to the end, in between, depending on how risky I am implementing my strategies, depending on how many trades I take, depending on what sessions I trade. This will influence the profitability of the models that I actually take forward. A little intermission here, and I just want to point out when we're talking about risk, guys, or risk management, risk to reward is important. But for me, I found that going for a fixed risk to reward was not the best. And I'll explain what I mean by that. Now, imagine you go for a 1 to 2 risk to reward and you're fixed, oh yeah, I need to take a 1 to 2. What if that 1 to 2 lines up with a price point that does not make sense? What if that 1 to 2 lines up with a swing high that has already swept liquidity and that's already protected? And this is when I moved from a fixed risk to reward to a system that favored market structure. I'll target imbalances, I'll target swing highs, low resistance, but I won't be fixed and mechanical in the sense that I have to take a 1 to 2, I have to take a 1 to 1.5, I have to take a 1 to 3, because what if market structure doesn't warrant that? And what if the market's showing me that it doesn't want to reach there? If you guys are looking for a little flowchart, have a look at these blue tabs here. And these are questions that you're going to have to define for yourself. I've just shown you a few examples. You need to firstly decide again, what's going to be your max loss limit per day? Now let's talk about a funded account, and let's talk about a $50,000 funded account. A lot of people have those, including myself. You have a $2,000 drawdown limit, which means if you lose $2,000, your account's gone. So if you aim to lose maximum $400 a day, that means you can lose 5 max loss days in a row before you lose the account, which is highly improbable if you have a profitable system like I showed you before. Now this is where you start, and then from there you can adjust this as you go on. So if I just scroll down now in this flowchart, you might want to take 2 trades a day. If you want to take 2 trades a day and your max loss is $400, then realistically all you can risk is $200 a trade. There's no perfect risk to reward. I want to really reinforce that. There's no perfect risk to reward, and you're going to find a happy medium where overall, guys, the biggest loser day or biggest losing day is going to be smaller than your biggest winning day. Number one, or you win a lot more days than you lose. So for example, I might have a 50% win rate, but I might win 5 days in a row. So I'm still winning one and then losing one, winning one and then losing one, but my winners are much bigger than my losers, and therefore I've built a profitable model, and therefore my account's going to grow. That is a profitable model in terms of risk management. Just speaking personally, what I do, I allow myself 2 to 3 trades, because what I've found is that it works best for my win rate and also my risk to reward. This allows me, as you can see on the screen here, to be wrong, but then also to come back and my winning trade to make up for my loser and make me money on top of that. I took a loss to start. I was not expecting price to actually come down and sweep this low. So I entered off an inversion, 2 contracts, I was stopped out. Then I entered again as this order block created, and that gives me the opportunity to make back what I've lost, but also make a bit more. If I would have taken only 1 trade, I would have ended the day down. However, I allowed myself to take 1 more trade and then ended up making my money back. You have to understand the principle of risk on versus risk off. I'll have to break up this section into 2 segments, as it's going to contain the bulk of the information, because this video I wanted to give you the pre-context of what's required before you even think about building a profitable model. Now we're going to talk about how to build that profitable model once we know what we're trading, where we're trading it, and if we're using props or if we're using personal. It's really important. Now on the screen here, there is a bunch of concepts, right? We've got a mix of PD arrays and a mix of concepts that ICT talks about, right? So we've got breaker blocks, fair value gaps, inversions, order blocks, opening range gaps, SMT on this side. And on the other side, which we'll go through in just a second, we actually have a bunch of other concepts which I think are quite important. But here's what I do, guys. Here's what I do. I would start with the stuff you're seeing here and look at some videos that ICT has posted, or maybe I've posted, that explain these concepts and then how to use them. Now, these aren't all the concepts. These are just some, but these are the ones that I've found the most success with. So if I just zoom across here, guys, these are some videos of mine that I would encourage you guys to watch. It's only about 6 or 7. All right, the first one is the ultimate ICT breaker block scalping strategy. I'll explain what a breaker block is, how to use it. Over here, I'll give you a model that you can use, a very simple model called the unicorn model that actually incorporates a breaker block. Talk about macros in this one, right? Talk about macro scalping in this one. Again, these videos will give you what macros are, but also how to use them. And then going down here, guys, we've got a few other concepts. We've got market structure shifts, macros and time, and also power 3 as we zoom across. So these are the videos I recommend that I've got. And then what I'll actually do, guys, I'll put these on the screen now. I would watch these videos from ICT. Now, before we move any further, I want to actually illustrate the point that any of these PD arrays here can be used alone, or they can be paired together to build a model. And if you want the hard work taken away, or some of it anyway, I've listed a few models that you can look at right here. So for example, you've got the unicorn model that uses breaker blocks. You've got the 2022 model that uses fair value gaps. My personal model is macros and then also inversion fair value gaps here. And I've got a range of videos, so do other creators, but what I'd encourage you guys to do, if you're new, study all these concepts, watch those videos, take notes, and then apply that to your own charts. It's not enough, guys. It's not enough to watch a video and say you understand it. It's not enough. Doesn't matter if it's my videos here, ICTs, any other creator, it's not enough. You need to understand this and apply it for yourself and take notes. And this is exactly what I did for the 2022 model. I've got a massive folder here and it has over 100 pages worth of content. I'm not mucking around. You guys need to do the same. If you want to build a profitable model, whether you're new, whether you've been doing it for a couple months, if you haven't found consistency and profitability, again, there's only two reasons, and one of those is probably lack of confidence from lack of learning and lack of data collection. So keep that in mind. Now, just hopping onto my YouTube channel so you guys can actually see the videos I'm talking about, I would highly recommend to go into my playlist tab and have a look here, right? So if you want to learn all about macros, which is what I personally trade, I've got 16 videos there, heaps. This one here, key ICT concepts, that's a really good one. And if we click on this playlist, key ICT concepts, you can see all these topics. This is going to take you through the basics, guys. And yes, you can watch ICT stuff too and other creators, but I've created these videos here to give you a simple way to understand these concepts. And then going back to the flowchart, guys, these are all these concepts here, right? Macros, optimal trade entry. If you're wondering what concepts I use a mix of any of these concepts at any given time. And when you're building a profitable model, the whole idea is to pair price and to pair time. Really important. What is price? Price are any of these concepts. And price is also any of these PD rays. What is time? Time is either silver bullet sessions or macros. And all those things I've covered here, but in my other playlists, I'd encourage you guys to check that out. There's not that much there. Take notes. And if you have questions, join my Discord and ask me any questions you want. I'm happy to help out. That's completely fine. To put simply, you can combine any of these things, like I said, any of these PD rays with any of these concepts, but you want to have a couple elements of price. Anything in blue is price, with at least one of these elements of time. If you can do that, you're on the right track, and you can combine anything. For me, I just choose certain elements that I like, and mainly it's macros, inversion fair value gaps, and probably low resistance liquidity. Those are the main things that I like to use if you're interested. Now, when we look at an example of how we can compare time and how we compare that with price, these are the things I'm talking about. So take a look at this photo here, and let me just zoom across, right? We've got a few PD arrays that are marked out. That's price, right? We've got our inversion fair value gap. We've also got our fair value gap. We've also got what's called low resistance liquidity up here. So I've paired three elements of price, and what time elements have I paired? Well, three time elements. Number one is the macro. So that's between these two lines here. Number two is the silver bullet session, and number three is the London Open session. And that's all I'm talking about here. So I've used these two time elements and I've combined that with these price elements here. And this is what you should do when you're building a framework or building a model, and it feeds back into one another, right? You've got to be the person to learn the concepts first, learn the PD arrays first, right? Learn all that. Just knowing what an inversion gap is, or just knowing what a market structure shift is, or what a fair value gap is, it's not enough, because a PD array or a combination of PD arrays is just how you enter a trade. But knowing when they present, knowing how they present, knowing how often they present, in which sessions they present, the combinations that work the best, that is what's going to build you a profitable model, which requires data collection and time. So be patient, take your time, and ask yourself these questions. Every single topic I've talked about so far. Number one, ask yourself this question, crucial. What sessions present the model or present the PD arrays and concepts the most? Number two, how often do the setups occur per day, per session, per week, per month? Number three, write these down again. When do the setups work really well? Crucial. And what combinations of PD arrays do you see appearing? Now, I'll just pause there for a sec, because a lot of people focus on, okay, it works really well here. Maybe I've collected 5 data samples and I think now I've got a profitable model. It's not the case, right? You need hundreds of data collection samples to actually prove that it's actually a profitable model. That's the first step, and then you have to follow the risk management like we talked before to ensure it's profitable. So my model is a macro inversion fair value gap model, and I could give you that model right now. I could give you the PDFs that I produced for the premium Discord, and you could still be unprofitable. But why? You've got the model, you've got the strategy. because your risk management is not the same as mine in certain situations. So you need to have risk management, you need to understand contract sizing, and you put that with the PDRA and with the model to build something that's profitable, because every single day you're going to choose when you're going to be profitable and when you're not. If you don't follow your rules, you won't be consistently profitable. But ask yourself this, ask yourself, when do the setups not work? Right? I want to know yes when they work, and I also want to know no when do they not work, because I want to sit out of the markets when they don't work, and that takes time to do. Not every market condition will be a trade that you can take. Just because price moves 50, 60, 100 handles does not mean you missed out on a trade. It means that if you sat on your hands, you followed your model that you collected data on, and now you're going to see success in the long term. So these are really important things. It might be hard to hear, but this is the reality of trading, guys. Not every move you have to catch, and it requires a lot of data collection and refinement. Also ask yourself this, which PDRAs, setups, or models are the easiest for you to see? If it's easy, you're going to be able to see it and implement it and collect data on it. If it's complicated or requires too many things, there's no point. Keep trading simple. Fair value gaps, macros, time, price. Keep it simple, right? Yes, price may be algorithmic if you follow ICT, but it doesn't mean it has to be complicated. It doesn't mean you have to try and bottom tick or top tick a trade. You follow your entry model, you take trades that go based on your data collection. This is another one. You've got to think deep as a trader. You can't be on the surface level. You have to think deep and think of this question here. Do a combination of multiple PDRAs, concepts, or models appear at the same time? For example, do you notice that macros, inversion, fair value gaps, and low resistance liquidity appear at the same time? For me, I notice that, and that's why I trade that, right? And then ask yourself, when you see these things occur at the same time, does this improve probability or profitability of the trade? These are deep questions, right? It's not just, oh, show me the 2022 model. Show me what it looks like. Oh yeah, I know what it looks like. I'll find that chart. No. You have to go back, take a step back, and ask yourself these deep questions and have answers to these deep questions. This one is a crucial one. That's why I came up with 10 handles, right? How many handles or points does the setup typically offer? And that's why I preach 10 to 20 handles for Asian or London session. So just trying to be realistic here, guys. And just to take a big zoom out picture of what we've got so far, there's a lot of moving components, but break it down. Pause each section on this video if you're still here. Pause it. And when you pause it, take notes. Create a checklist for yourself and follow this process all the way through. I'm aware there's a lot of moving parts here, but I've simplified it even further. I want this to be as easy to interpret, as easy to actually create an actionable step after watching this video. A successful model has these questions answered. Write these down. Number one, you need to know, or you need to be able to anticipate, where can price react from? An example I've got down here is from a 15-minute fair value gap, right? This is the example I showed you just before. We've got a 15-minute bullish gap right here. Price can react from that point. The key word, guys, is can. You don't need to know 100%. You just need to know where it can. Where does it often react from? And in my case, I see this react from 15-minute fair value gaps. Number two, when can these reactions happen? So these words are really key. Where, which is where on the price chart. Is it equilibrium? Is it a 15-minute fair value gap? That's where. When is time? And we've talked about time elements before, but in this case, we talked about time being the macro, the silver bullet session, and London Open. And then you ask yourself this question, which? So when, where, and which? Which PDRAs or which combination of PDRAs illustrates that price may react from that level in that key time? It's as simple as it gets, guys. And in this case, we said that the combination of the fair value gap and the inversion fair value gap indicate a reaction during a key time frame, being the macro, reacting from a point in the price, which is the 15-minute fair value gap. And that's just one example. I would encourage you guys, when you're building a model, to do these things. Doesn't matter what model you choose. Like, these are models that you can study that have made videos on, like Unicorn Model 2022, this one, they're all models, right, that you can try to trade and research yourself. I've made plenty of videos on these models, and these are the videos I talked about before. But that is as simple as I can get it, to break down what my strategy is and what I look for in the market every single day. It repeats. Repeatable patterns, execution, risk management. Repeatable patterns, execution, risk management. Repeat the process and you will see success in building a model and then implementing that. Just to go through these 3 questions again, we can use a video that I actually posted about 2 weeks ago. Check it out. It's called How to Trade ICT Macros, one of my A+ models. But have a look here, right? Have a look at answering these 3 questions. The first question we had, I'll get on the screen, is where can price react from? And if you can see here between these 2 blue lines, I've marked out optimal trade entry. That's the where. Cool. When can price react? We've got the macro between these 2 lines here. And which PD arrays or combinations of PD arrays indicate for me reversal? In this case, I've got this inversion, but also this down close candle. When we break above that, we have a change in the state of delivery. And this is honestly how it goes, right? This is a trade that I personally took, and you can see me adjusting the risk to reward. These are all things, right, that you'll figure out for yourself. But I would encourage you guys to go back, watch these videos, because I talk about how to manage drawdown, moving my stop loss, when I move my stop loss. And these are things that when you develop a model and you've collected enough data on these models, guys, you will know when to do that. It's very hard for me as an educator, as a mentor, or even, as someone trying to give some kind of guidance to someone to tell people exactly what's going to work for them, because I'm not a financial advisor. It's not financial advice, but this is what I personally do. And you're going to find something that might be a combination of what I do, but you might mix up a little bit based on how you like to trade. That is really important, but I wanted to show you this example just to break down those 3 questions again. It just seems so easy, right? Like all these things I'm saying, you're understanding, yeah, that makes sense, but why are so many people still unprofitable? Why did it take me so long to become profitable? And there's only 2 reasons, in my opinion. Number 1, risk is not followed, or you actually don't have a strategy that you've collected enough data on to feel comfortable executing. Now, when you're executing not just to take a win, but also to take a loss. A lot of people don't feel comfortable taking a loss and coming back from that loss. I'll show you guys an example earlier in this video where I took a loss first and then I came back and took a win. Right, I'm recording this video today over multiple days, but ultimately there's been many days in the past where I've taken a loss to start and win after, but you have to be confident, and confidence comes from data collection, which is the next topic on how to build a profitable model. All right, so how do you collect data anyway? Like, what's the process that I use to collect data? What would I suggest if I started again? And by the way, all these things, guys, if I had someone here like this telling me what I needed to do and I followed that, it would have cut down my time to profitability at least in half. You still have to put in the work, right? It's not going to happen in multiple weeks, like 2 weeks. It's going to take months, if not years. But this would have cut it down really, really fast. So how to collect data, ask yourself a few questions, but ultimately you want to understand, well, how can you improve your accuracy, and can you add or remove things from the model? Those are the questions you want to ask yourself, and you're doing this based on what you can trade and what suits your lifestyle. Like we talked about before, guys, some people can't trade the New York Open session, and I can't, right? New York AM, it's too late. So what session suits you best based on volatility and convenience? Also ask yourself, how often do you see things happen per day? When does it work? When doesn't it work? Because you want to be able to do this. You want to actually know, you want to know exactly what you're looking for every day, any session, any week, any month, any year. Doesn't matter if it's election week, doesn't matter if it's FOMC day, doesn't matter if it's NFP day. You want to know exactly how your model should present and whether or not you should come into the market and put risk in the market. And just to show you guys a few examples of what I've collected data in the past, like this is in a private Discord I've got when I first started. And these are all the topics, right? I used to trade Forex, as you guys know. So you can see here, GJ, USD, JPY, Asian session, homework. I'm creating homework tasks. I'm doing in-depth analysis. I'm taking screenshots. Like, these are things I've been doing all the way since I first started learning. And I'm commenting on the charts. I'm talking about what happens on CPI, what to anticipate. How long does it take for reversals on CPI? Like, what are different sessions like? If you have a look over here, different trades, maybe why it was good, why it was bad. And even this is from the 19th of July, 2023. And I say here, I entered a long trade in the blue box. Looking back, there was no big displacement. There was no valid trade to take. There was no valid trade to take. I'll repeat that once again. There was no valid trade to take. Being able to determine this is going to save you this. If you are unable to determine when to sit out of the market, guys, there's going to be no profitability, there's going to be no success, because you can execute all the time when you see the right market conditions. But what about the wrong market conditions? What about, if the conditions don't suit your model? If it's too choppy, if it's too volatile, if it hasn't tapped into OT, whatever it might be, you need to collect the data for yourself. And this just illustrates the work that's required, guys. Like, I've been collecting data, I still do to this day, for months and years, right? Every single day. Now for the premium Discord, every single day, right? I'm putting posts in there. Every single model that I've developed, which by the way, these are my 3 models, those have come from hours and hours and hours and hours of back testing, studying, data collection, just hours of losing and winning and thinking I knew everything and then getting knocked down, and thinking I knew everything and then getting knocked down. And that's the process you have to follow. But you have to have like utter and strong belief in yourself that you're going to make it work. Because if you don't have that belief, if you don't have that confidence, if you can't stick it through the hard times, then you're never going to see the good times. If you can't take 2 losing days, if you can't take a losing week, if you can't take the thought of losing a funded account, which you will, then trading's not for you, because it's a hard industry. But I wanted to know exactly how the markets worked. I wanted to collect data so I know exactly how the markets worked, why they did the things they did. And in my head, the market went through patterns, and I started to see these patterns repeat, and that is how I came to this conclusion. And that is how now I teach 3 main models to my premium Discord and personally trade myself, because I know now that any session I can trade in. I know that any combinations of PDRAs I can use, but I've chosen a few that I like. And I now know what makes a high versus low probability trade, which you guys can do yourself. That's really, really important. I truly believe that if you put in the work, if you follow this flow chart, if you actually do these things, you will see success, and you'll see it quick as long as you submit to the process. Now this here is a complete breakdown of what you can do, the steps you can take from the very start all the way to the end in terms of how you can build a profitable model. We've talked about the different PDRAs, we've talked about risk, we've talked about choosing props versus personal, we've talked about risk management, risk to reward, the different ways you can be profitable, how to pair time and price, how to collect data, the types of data collection I've done. I've given you a few examples here of things I've personally taken and trades that I like, and the framework that surrounds that. But ultimately, let's just break this down now into a few actionable steps. If you're still watching this, let me know below. And if you like this video, guys, give this video a like. If you're not yet subscribed, subscribe to the channel. This has been a long video, and hopefully this has been insightful for you guys in terms of what's required. Breaking it down step by step, the things that go through my mind, and cutting out the BS, because a lot of nonsense that goes on in the trading industry. This is what needs to happen in my opinion, and this is what I need to build profitability in the market. So let's break this down now. Step number 1, I'll get this on the screen. Step number 1, you want to choose your instrument. Futures, Forex, or commodities. Step number 2, you want to choose prop firms or personal. Step number 3, you want to choose a session, right? So we talked about different sessions here and the volatilities of each. Step number 4, you want to choose 2 to 3 PDRAs, and you want to pair that with at least 1 or 2 time elements. Now, all these blue things are related to price, and these green things are related to time. So ideally, you could pair 2 of these things, and then a time element, and then a couple of these blue things here, because these are all elements that are important to understand to build that model. And just for those that are watching now, I'll talk about what I mean. You could see, for example, price trade into optimal trade entry, and that's when you look to take a trade during a macro using an inversion fair value gap. Now, do you have to use the optimal trade entry? No, but you can. So that's just an important thing to keep in mind. Step number 5, study these things, right? If I had to recommend anything, I'd study low resistance, macros. I'd also study liquidity sweeps, the power of 3. Anything here is what I'd study, right? These are the key elements. Study these things, look for these in your chart and actually document that. And then develop a model combining these things together, collect data on that model, and then refine and repeat. Now, if you're lazy, hopefully not, if you're watching this video, but these are models that you can try for yourself, which I've already collected data on. They work, they're profitable. You can use a unicorn model, the 2022 model. I use a macro inversion fair value gap model, right? Quite easy. I've got plenty of videos, like I said, on these models here. But again, if you got value from this video, please give the video a like. If you're not subscribed, click that subscribe button. And if you want any personal help All my links, I've also got one-on-one coaching now. They'll be in the link of this YouTube video. But until next time, guys, I'll talk to you soon. If you need any help, feel free to join the community. Peace.